And also, I've vowed, I've never been real good with names and faces, and as of last semester, I vowed that I'm going to get better at that. I probably don't have a good shot at memorizing all 68 of you, but when we're talking and I ask you what your name is and I'm looking at you kind of funny, that's why, because I'm trying to get better at names and faces. So that's what that is all about. So I've already got a couple of you. Philip, I already know a couple others as well. So. I think that's it in terms of announcements. I didn't get around to doing anything with the exams yet, so they're still not posted on there, but I'll get that either this week or Monday for sure, so that'll be plenty of time for the exam. Other than that, I don't think I have any other announcements. So questions about anything before we get started? Questions?
I wasn't going to say you have an extra syllabus.
I don't. It's posted on Canvas. So you can print it up there. And if you haven't done so already, make sure you go onto Canvas and familiarize yourself with what's on there. Especially, don't ask me why they did this, but they have a pages link on the left, but then all the pages are listed on the right. I didn't design it, I just got to use it. So make sure you look at the pages, because that's where I have a lot of information posted for you guys. The easiest thing to do when you look over there on the right, it'll just say something like show all pages. Click that, that has all of your, the in-class examples that I do and so forth, the homework solution and so forth. So, okay? Other questions? Other questions? Okay. Let's go ahead and get started then. After most of you left yesterday, we just had kind of a basic Excel 101 tutoring session, and I think actually everybody's pretty much up to speed. My understanding was most, if not all the people that stayed, were staying just to make sure they didn't miss anything. They actually do everything we went over. And that's pretty much what Chapter 1 is about in the book. Now, as we go through things, particularly, and you'll see this in a few minutes here when we start going through the financial statements. If you see me doing something on Excel that you don't understand, that's your opportunity to stop me and say, hey, how did you do that? Okay, so that's part of what we're here to do. Like I said yesterday, this is a finance course, so we'll be talking about finance, but what we're doing is we're using Excel to do all of our calculations and everything. So if you see something that you're not familiar with, stop me. And let me know. Also, be reminded, especially for those of you who are very good at Excel, there's more than one way to do pretty much everything in Excel. Okay, so we don't need to go through every single way to do every single thing. All right, I'm showing you what I do, and like I say, I'm not going to get on the exam and ask you Excel questions. I'll be getting on the exam and asking you finance questions, and you'll be using Excel to answer those questions. Okay, with a couple of. I told you yesterday I think there were 2 or 3 exceptions, and I don't think either of them pop up until the last third of the course. Okay? All right, so that's pretty much what Chapter 1 is about. However, I do want to point out a couple of things to you in Chapter 1. One is the importance of paying attention to your order of operations when you're putting formulas into Excel. Okay, for example, if you were going to put in the present value of annuity formula into Excel. Okay. Anybody remember what the present value of annuity formula is?
Present value of annuity.
It's present value of annuity, yeah, the formula. No, I don't mean the function. I mean the formula, the mathematical formula.
Cash flow.
Okay, if I may, payment. Oh yeah, you have it.
Cash flow divided by 1 plus K.
Close enough.
Time? Yeah.
1 minus, you got me messed up now. 1 divided 1 plus r over n to the r. Right? Okay. You remember that, you just don't remember. Okay. So if we were putting this, oh, by the way, also something else, I know my handwriting stinks. If I write something up here that you can't read, please ask me about it. You won't offend me. When I take my time, I can write legibly, but I usually get in a hurry in class, so I sometimes scribble things up here. So if I write something that you can't read, please ask me about it. It won't hurt my feelings. Okay? So if we were going to put this formula into Excel, make sure you pay attention to your order of operations. And really, as finance majors, you should do this, okay? If for no other reason than your own intellectual curiosity, okay? But this is also another way that you check to make sure that you understand the formula that you're using. Okay, and I'm going to show you the importance of that in just a second. So, in fact, I was talking to, I believe it was Tommy, right? I believe I was talking to Tommy after class yesterday, who was looking for a job, or somebody was looking for a job or something. Yeah. And they were actually more interested in someone with a strong mathematical background than a strong finance background. Okay, so as finance majors, you should, number one, really you should know this, but also you should be interested in plugging this into Excel to make sure that it actually works and is consistent with the formula. So if you're doing this, again, my point is pay attention to the order of operations. So let's say we're going to do, all right, payment, see what's going to be rate, and rate, and all right. So let's say we have the following annuity, and we're going to put this into Excel. All right. So we have a $350 annuity. The rate is going to be 5% a year, but if the payments are monthly, let me zoom in on that a little bit. Better? Okay. All right. So the rate is 5% a year, but if the payments are monthly, then that means the periodic rate is going to be, or at least how we calculate it. Yeah, recall that interest rates are always quoted annually, but 99% of the time, however frequent the payments are, is how frequent the compounding is. So if our annual rate is 5%, then our periodic rate is going to be 0.4167%. Okay, this is actually one of the nice things about doing Excel on the exam, because you don't have to worry about rounding. Somebody asked about rounding yesterday. I don't remember if it was before or after the break. But you don't have to worry about that, because whatever it is I have on the exam, all you have to do is take your spreadsheet and round it to whatever I have, and there you go. Okay. So this is going to be our periodic rate, and then of course our number of compounding periods would be 72, right? Okay, so we're going to put in this formula. To make sure that I get the order of operations right, what I do is kind of work from the inside out, right? And it's very easy to make a mistake, and I noticed when I was practicing this earlier this morning, I made a mistake. It's sometimes trickier than it looks, but what I do is I kind of work from inside out, and once I get one piece in there, I hit enter to make sure that that piece is right. Because if you get to a certain point and you hit enter and it's wrong, then all you got to do is hit escape and start back from where you just left off, as opposed to starting back from all the way from the beginning. Does that make sense? Does that make sense? Okay. All right. So what I'll do is I'll put in 1 plus our rate to the term. So this is this little piece right here. Okay, I'm hitting enter, so I know that's entered correctly. Then after that, and a quick way to pull up the formula in case you don't know it is to just hit F2, and it'll pull up the formula right here. And by the way, asking questions, particularly in this course with everybody that has such a varied Excel background, really helps me out, and therefore helps you out, because it helps me gauge what you know and what you don't know. Okay, so if you're not asking questions, I'm assuming that you are on top of it. So if you're not on top of it, ask your question when you know. Okay?
And what did you say about F2?
That pulls up the formula right here.
Oh.
Okay, so I just put in F2, and now I'm going to do the 1 divided by all of that. I'm going to hit enter. So far so good. So I put in this piece here. Then 1 minus all of that. Does everybody see what I'm doing? Everybody with me? Okay. Again, these are things I've been doing this stuff for a long time, so I just kind of don't really think much about it, so make sure you ask a question. So we got the numerator in now. So we need to divide all of that by R. So I'm going to put my parentheses around all of this, divide by, and I need to use my mouse to click on that, rate. And those of you who took old school accounting, that number right there probably looks familiar. Remember the tables? Did anybody? I was shocked. I talked to somebody just recently. They took, I guess it was one of the beginning accounting classes at, I don't remember if it was Seminole State or Valencia or where they took it, but the accounting teacher was teaching annuities and everything with the tables. Did you guys do that? Did you? That's shocking to me. Okay. So that's where that number comes from, right there. And then we're going to multiply all of that times our payment, if you did it right. I know that's the right answer. Okay, so again, my point is putting in the order of operations correctly, and pay attention to that, because if you don't, your result will be wrong. And in this case, and this is the piece that you guys as finance majors, as graduating how many people are graduating in December? There we go. All right, I figured that out on, right before class. So just a couple of you are graduating now, the rest of you are graduating in December. Okay, so as graduating finance majors, this is the stuff that you would want to do. All right, so now let's compare this with the formula. All right? If we get the same answer, number one, we're pretty sure it's correct. Number two, we are pretty sure we understand the formula.
Is it? Can you highlight that one more time? Because I don't know how to do the formula inside of there, like double click it. I'm trying to figure out where I'm.
Yeah. I would have to look at it, but I would be willing to bet that you got your parentheses and stuff. Okay, so if we want to double check this with our Excel formula, which formula are we going to use, or the function, which Excel function are we going to use? The present value function, all right, which would be under our financial functions. Okay, so recall I can either find it here or, like I showed you yesterday, under insert function. Okay, so there's our present value right here. Give us all of our inputs, so we can just plug those in, noticing that what I'm plugging in is the periodic rate, not the annual rate. So moral of that story, you got to understand that this function accepts the periodic rate. Okay. So far so good? Okay, I feel like I'm going 100 miles an hour. So everybody good? Okay. Our number of periods, payment. Our future value is going to be 0. Type tells us payment at the beginning is 1, payment at the end is 0. What is that getting at? Ordinary versus annuity due. Okay.
I'm
Yes,
sorry.
sir.
Can you make that bigger?
The screen?
Yes.
Yeah. Yep. So we click that, and so click that, and actually this comes out negative, which is more theoretically correct because, yeah, this would be a cash outflow. So remember your cash outflow, inflow stuff, positive versus negative. Okay? All right. So again, several points here. The first one was getting your order of operations correct. Okay? So be careful doing that. The way I do it is to work inside out and hit enter each time to make sure that it's accepting at least that piece correctly, and then go on from there. Also, comparing it to your Excel formula to make sure that, number one, that the Excel formula is doing what you think it does. Okay. All right, questions so far? Yeah.
How did you do the when you did the formula? How did you
I
get?
can't hear you because I got conversations going on up here. I'm sorry.
How did you get the formula from the finance the
Just
formulas?
here?
No, the one that you did the Excel.
Oh, the Excel function?
Yes.
is under formulas.
Yeah, I didn't get, like, for example, for rate, what number did you put in for NP or?
Oh, I put in the numbers in cells B1 through B3,
Okay.
okay? Which is part of the point of this, is understanding that what this function is looking for is the periodic rate and the total number of compounding periods, but especially the periodic rate.
Okay.
That's what students tend to mess up because they'll put in the annual rate,
I see.
but that's not what you need. You need the periodic rate.
Periodic.
So either I could put in the periodic rate like that, or I could have put in the annual rate and just divided by 12 there. Either way, I'll get it. Like either way, what it's looking for is the periodic.
Period. Thank you so much.
Good. Other questions? Other questions? Okay, good. All right, so that was one thing that I wanted to point out to you in chapter 1. The other thing was kind of on a related note, making sure that you understand what the function does. The book gives you an example, and this is part of my class examples. This is posted on Canvas. The book gives you an example of this where they're asking you to calculate the geometric average of returns. Okay, so let's go through an example of that to see to make sure we understand this function. Again, the bigger picture being make sure you understand the functions that you're using. So let's say we have some data here. I don't know, stock prices, earnings per share, whatever that may be. First question is to calculate the arithmetic average. And by the way, even though this is a very simple example, this is kind of what you can expect on the exam. Okay, so I give you some data in Excel, and then in the quizzes in Canvas, I ask you several questions about those data. Okay, calculate the arithmetic average, calculate the geometric average, calculate standard deviation, etc. Okay, so that's what you can expect on the exam. Okay, so if we're going to calculate the arithmetic average, what's the first thing we have to do?
Subtract
The arithmetic average growth rate, excuse me.
subtract if you're going for the first one, subtract period 2 from period 1.
Okay, so we need to convert them to returns or to changes. Okay, which we will do our P1 minus divided by P0 minus 1 stuff. And we don't want dollar in there. Okay. So we can copy all of that down, right? Of course, we could do this two ways. Well, I mean, we could do it several ways. If we were doing it on a piece of paper, how would we calculate the arithmetic average of this? I'm getting to a point here. Add them up and divide by 5, remembering that when you convert prices to returns or to percentage changes, you lose 1. Okay? Make sure you remember that because this is an obvious example because there's only 6 on here. If I gave you on the exam daily stock returns going back to 1970, it wouldn't be as obvious. Okay? All right, so we could divide by 5, so we could simply add them up and divide by 5, right? Yeah. I'm sorry, did I do what? Yeah. Yeah, the first one. So this is your P1 divided by P0 minus 1 stuff. Yes. Yeah. If you prefer new, what do you say? New divided by old minus 1, not minus old, minus 1. Or new minus old divided by old. I'm not used to saying it that way, but yes, that would be correct. Okay, good. Now we're getting some questions. That's just the way I like it. I'm sorry, what's that?
Why is there a plus?
Okay, Why is there a plus in front of here?
It's best.
Yeah, I put a plus in there to tell it that it was a number rather than a label. Okay, remember we went through that yesterday. All right, so you could put either a plus or a minus, or you could just put the equal sign in there. If you put in, not that, if you put in 50, that would still make a number, but sometimes when you put it in, it will accept it as a label rather than a number. I think Excel in Mac, I think it does it in there quite a bit. By the way, I told you guys yesterday that I've become a Mac geek, and I do most of this I do in Mac these days. But actually, in my opinion, Excel and Windows works better. I mean, for what I'm doing, I can get by in Mac okay, but I think Excel and Windows actually works better. I can work more efficiently in Windows than I can in Mac, just for the record. Other questions so far? Yeah.
How did you get the 18.159%?
Okay, that's the arithmetic average of all of these returns. Okay, which is simply the sum of the returns
Divided by 5.
divided by n. Yeah. Sum of x divided by n equals average x. Okay, and yeah.
Is it n or is it n minus 1?
Well, a little bit of semantics. It's the number of returns.
Oh, okay.
So if n is prices, then it would be n minus 1. If n are the returns, then it would simply be n. Okay. But more importantly, remember that when you're converting prices to returns, prices to changes, you lose 1. So we have 6 prices, but only 5 returns. Here's your first exam tip for the semester. Fair warning, one of the answer choices will be as if you divided by 6. Okay? I'm not doing that because I'm mean and nasty and I'm trying to fail you in the course. I'm doing that because graduating finance majors should be on top of that. Okay? That would be a big mistake to make if you were analyzing investments, companies, whatever what you're doing. Especially with only 6 returns. All right, other questions? I love questions because it helps me gauge where we're at. I look out to see a sea of faces. I don't know if you guys have played it well. Other questions? All right. Okay, so what I was getting at down here is that we could calculate the average a number of ways. This is using the sum function. Yeah. Give me 1 second. I need to grab this. Hello? Yeah. Oh. Okay. Okay. Okay, I appreciate you checking. Thanks so much. Okay. Sorry, that tricked me. Thought that was the number. It wasn't. They don't have it. They don't have it. Okay, so what I was getting at here, this is an example of the sum function. We could do the same calculation by doing sum of these and then using the count function. What's that? Well, this would be useful, again, you know, if I'm giving you daily stock returns going back to April 4th of 1971, then instead of manually counting it, then you can just plug this formula in and it will automatically calculate in for you. Or if you're working with data where you're deleting things and adding things and you need to recalculate it, then this will calculate that for you. I'm sorry, what were you asking?
No, so the other part of that is when do you know that you need to do the N-1? If you don't use the count at that time because it's just taking a hard number?
Well, if my count were on the prices, then I would have to do count minus 4.
Oh, okay.
You hit count in like E4 to E9, would it count 6 or 5?
It would count the correct number because, and that's a good question, because there's nothing in these cells.
Just making sure.
Yeah. if we put a label in those cells, I don't think, yeah, it wouldn't change anything. Obviously,
If you put a percentage.
yeah, if we put a number in there, obviously it would.
Okay.
But if there's nothing in there, it's not going to do it. And if there's text in there, it appears not. You got to be careful with that stuff, though, because I've been doing this stuff for a long time, and I saw yesterday, when I had that yesterday, was that before or after the break? I don't remember. I think it was after the break. Whether you have a number or a text in here will sometimes affect your calculation. Okay? So you got to be careful of that. Right? Which goes back to make sure you understand exactly what the formula is doing. Again, these are easy examples with 6 prices. Okay? Consider calculating daily returns for all of the stocks of the Dow Jones Industrial Average going back to 1970. Okay? That's a lot more, and that's where this kind of stuff really comes into play. Okay. Other questions? I love it. Yeah. It's counting whatever you tell it to count. It's counting whatever you tell it to count. Yeah. Well, not the numbers, it's counting whether or not there is something in the cell. So when it's counting, it's saying 1, 2, 3, 4, 5. Okay? And that's why here we're getting the same answer as the cell next to it, which is where I just put in 5. Okay, so it's not adding the numbers, that's what the sum function is doing. Okay. Other questions? Other questions? I like it. I like it. Seriously. Other questions? Okay. Also, we could do the average function. Okay, so that's the arithmetic average. So again, on the exam, if this were an exam question, you calculate this. Exam test-taking technique, if you do it a couple of ways and get the same answer, then you're probably in a pretty good shape for the answer. You go to the quiz, you pick that one, and move on the way. Okay? All right, next one is calculating the geometric average. By the way, I have over here, I have all of the answers right here, and they're grouped. Okay, so in case you're not familiar with grouping, if you go to the data, and this is very useful, you'll see this on financial statements in a few minutes. It's very useful on financial statements. If you go to data, and right over here, you have group or ungroup, and what you can do there is group rows and columns, rows or columns together. Okay, and it makes it very easy to read. So in this case, I'm using it to actually hide the answers. All right, so I have the questions, and then there's the answer here, which is what we're just calculating up here. And the way you do that is simply, in this case, I want to group rows. So I simply select the row, and since they're already grouped, I'll ungroup them. And now it's just a normal Excel spreadsheet. But if I select those rows and hit group, then it will group them all together, and that's how you expand it and contract it. Makes it particularly when you get like big financial statements, for example. Okay? And you want to collapse it just to sales, gross margin, operating income, net income. Okay? So you can do that, so you just have 4 lines, but then when you expand it, you have, 58 lines, or however many it is. Okay? And this is part of organizing your spreadsheet, which is one of the best practices we'll talk about in just a minute. All right, so the next question is calculate the geometric average growth rate, and how do we do that? How do we do it mathematically as opposed to in Excel? I'll give you a hint. You add and take away a couple of things, yeah.
You multiply the average each other and minus 1.
Okay, I think, I didn't hear exactly what you said, but how about, assuming I can write it correctly. which is what I have right here. That's the arithmetic error. That's what I have right here. Okay? Pay attention, because you probably run across this on the exam. I'm getting this bunch of pound signs right here. What's this mean?
Expand.
Yeah, the number is too big for the column, so I need to expand the column. Right? If you're not familiar with that, make sure you make note of that, because if you don't, inevitably there's going to be something in the database on the exam where they're going to have this, and if you don't know how to deal with it, you're not going to be able to answer the question because you don't know what the number is. Okay? And these are the little things that sometimes happen on the exam that trip up students. Okay, so we need to expand the column, which we can do by simply go up here to the top, and on the right side of the column, hold down left click. You can expand it that way. Also, if you double click on this, then it will automatically go to the correct width to accommodate the maximum number in that column. So far, so good? Okay. All right, so the first example I have here is just simply plugging in this formula right there and calculating it manually, which gives us an average growth rate of 14.869%. So far, so good, right? Okay? All right. The next example they give you out of the book is using the geometric mean function, the Excel function, to calculate the same thing. So what I have here is, here are the returns, like we got before. I use the geomean function in an attempt to calculate the geometric average of those returns. And I get that error sign, why? Okay, because that geomean function cannot deal with negative numbers. Okay, so we need to change those numbers to positive, which is to say, not subtract a 1. And that's what I have right here. So I used the new minus old, whatever kind of stuff you were just saying, P1, P0, minus 1. So this is how we calculated the returns. So what I did was just take the minus 1 out of it, which is what we have in all these columns here. That's to get rid of the negatives. Right? And then use the geomean function, and it's telling me that the geometric average growth rate is 115%. Is that right? No, for two reasons. One, we already calculated the answer, which is yet a value no one had to do it the old school way. But more importantly than that, that doesn't pass the reasonableness test. Okay? When you're doing these calculations, and I'm as guilty as anybody in this room of this, sometimes you get so lost in the details that you forget the big picture. Okay? I mean, if you just look at these returns, an average growth rate of 115% doesn't make sense. So it can't be right. Well, in this case, what do we have to do? Subtract 1 from the geomean function, which is what I have right here. So why they set the geomean function up that way, I don't know, but regardless, that's the way it is. So my point here, actually there's 2 points. One is another example of make sure you understand what the Excel function's doing. Okay? The time to do that isn't 12 hours before the exam. Make sure you understand what it's doing. Also, notice, recall that arithmetic averages are always upwardly biased. They're always upwardly biased, which is to say the geometric average is a more accurate reflection of changes in wealth. There's also another calculation that we do. We use this almost exclusively in academics, that more accurately measures changes in wealth. And what is that? Rather than arithmetic average or geometric average, that would be the, anybody know? The log change. The log change. I don't know if you've run across that in any of your other courses, but that would be the log of nu divided by old. Log of P1 minus P2. So if we were going to calculate the log change of this stuff, then we would use our log function. That's another way we do it. Now we'll get into that stuff when we get into the investment section of the course. Okay. All right. So far so good. Okay. See, what else was there in chapter 1 that I want to call your attention to? On the exam, I told you yesterday what we're going to focus on in this course are the calculations. I've never been a big fan of Excel's charting software, although I've gotten better at it over the last year, kind of out of necessity. I haven't found a better charting software. And some things that happened with one of my papers over the years that kind of forced me to get better. So I'm more warm towards Excel's graphing functions than I was in the past. But I'm not going to worry too much in this course about the presentation. What I'm worried with you in this course is the calculations. Okay? But there is one that I do want you to be familiar with because it's so commonly used in finance, and that's the scatter diagram. So this is about as far as we'll go with the charting and with the presentation stuff. So for example, I might give you a set of data like this on the exam, S&P 500, ExxonMobil stock prices. Okay? And I might ask you to calculate or to estimate the beta of Exxon versus S&P, just as an example. Well, the first thing we need to do is to, if we're going to estimate the beta of these from a graph, and where I'm going with this is what I would do on the exam is I would ask you that question, and then I would give you 4 graphs on the exam, and I'd say which one most closely resembles the correct one. Okay? So what you got to do is go in here, do a quick scatter diagram, and then pick the answer. Okay, so that's the exam application of this. So if we were doing that, what's the first thing we need to do? So we're going to estimate the data. Well,
Select the data?
yeah. Well, I mean, we need to select the data, but what calculation do we need to do?
Return. You have to do a return and
Yeah,
compare it
we
to
need to
the.
convert the prices to returns. Okay, that's the first thing we need to do. All right. One of your best practices in Excel at the end of the chapter there is to create organized spreadsheets. And I'm not always real great about this myself. I kind of get in a hurry sometimes, get lazy sometimes, so I kind of cut corners on this as well. But on the exam, I would encourage you to take the 10 seconds that it sometimes takes to do that, because when you start doing a bunch of calculations, and then I say, 4 or 5 questions later, okay, now change this number and see how everything changes. If you're not organized, then it's easy to get lost in all of these calculations. Okay, so I just moved my ticker symbols, but I moved my identifiers over to these columns to calculate returns. I have the prices for, what's that, 10 years on here, so going down row 127. So a lot of prices, but it actually should be very quick to do this. Okay, this is one of those efficiency things that I was talking about yesterday. So we got our new divided by old stuff. Okay, we're doing this right here. And then what do we need to do? Yeah, just copy and paste it all the way down. did this, I wasn't sure if, wasn't sure what was going on there.
How did you do it at the same time with both indexes?
Okay. What I did was, I just copied this. By the way, something that I mentioned yesterday, and I do this as often as I can for efficiency. What I prefer to do is, whenever possible, is to keep my hands on the keyboard. Okay? Because when I take my hand off the keyboard, to go fumble and find the mouse, and then take the mouse and wake it up, and then move the cursor over to whatever it is that I'm doing, and then hit right click and do all that, and then take my hand off that and put it back on. If I can just do a keystroke to do the same thing, that's what I do. Okay? If you're very quick at doing that, power to you. Okay? But what I prefer to do is keep my hands on the keyboards whenever I can. So what I did here was simply copy it, and I actually have a video on this, but if you hold down the shift key and use your arrow, so what I'm doing is arrow over and then page down. One of my videos is on this. And then I just hit enter, yeah. So I just copied and pasted, noticing that what I was doing was, this is a, I'm thinking circular reference, that's nice. An absolute reference. No, I'm sorry, relative reference. I was thinking circular reference. It's a relative reference versus an absolute reference. So what I was doing here, this formula is saying divide that by that, minus 1. So if I copy that over, then this formula is going to say divide that by that. You with me? And then when I copy it down, it's the same thing as opposed to a absolute reference, which we'll get to in a few minutes. Okay. And then I just hit enter. Okay. Does that answer your question? Okay. And there's a question here.
No, my concern is when you copy it over, it's going to move the cell with focus.
Yeah, okay, so we're good?
Yeah.
Okay. Sir?
When you do the shift page down, how do you do that on the Mac?
The same way, I think.
Command probably.
Yeah. On Mac, usually, well, no, not command, because usually Alt on here is command on there. By the way, any of you that have Mac, if you want it, I have a clean list. There's not a whole lot of stuff on there, but a lot of stuff that I do, which might have this on there, of how you do something in Windows versus how you do it in Mac. If any of you want that, email me, I'll be happy to share it with you. But you should do it the same way. Other questions? By the way, I asked the testing lab today, and they don't have Macs down there. I didn't think. In fact, one of the guys told me that Mac was the devil. I'm sorry. He said Apple is the devil. So we got into an argument about that. It didn't escalate into a physical altercation.
Can you make it larger? I'm sorry.
Other questions? Noticing when I made it larger, I lose some of my dates, so if that's important. Other questions? Also, be careful, because when I copied it down, all the way down here at the bottom, I'm getting an error because, remember, you lose one. So this is the one that I'm losing down here, so I need to get rid of this. All right, so far so good?
Yep.
Okay, so these are returns, and then what I'm going to do is I'm simply going to insert a scatter diagram. You have several choices here. Probably what we'll just run with is this one here. If you right-click on this, you got select data. Right here, let me know if I'm going too fast. And then that's a new one. There we go. So that was right over here. If you add, this is apparently something new since the update that I've got. here's where you put in your X and Y values. So again, so understand what we're doing here is we're doing a scatter diagram to estimate beta, for example. So what would the X values be? What's that?
The SP 500.
It'd be the S&P 500, which is our proxy for the market portfolio. And then our Y values, of course, would be Exxon. And let me shrink this down a little bit because you can't see it. Okay. So, example A, basic scatter diagram, then you go on the exam and pick which one you use. Okay. But again, this is a commonly used diagram in finance. Okay. But that's about as far as we'll go with presentation type stuff. Okay. Questions? Yeah.
Can you show one more time how you did the chart? You went so fast.
Yeah, you go to insert, and then scatter diagram. Insert scatter diagram. That would actually be a good tutorial video.
Okay.
So if you want to email me or remind me, I'll throw that on there. Other questions?
Scattered.
Okay. So then the last thing that I just want to call your attention to in chapter 1 was at the end, those 5 best practices of spreadsheets. Make sure you look at those. I know it's kind of tempting to just blow past the chapter 1 stuff because it's usually introductory stuff, but these are actually good tips that I do all the time. Particularly the separate input area, probably a good idea on the exam. Again, depending on what it is we're doing, because you'll have an input area, and then sometimes, we're doing financial statements. We're going to do financial statements to calculate net income, and then I'll say, okay, what if sales are $75 million instead? What would your net income be? Okay, so maybe for something like that. The second one is also use formulas whenever possible, which is related to the same thing that I just said. And that one, that's where the count function that we were doing over here, that's where that really pays dividends. Okay, because if somewhere in this big spreadsheet, instead of saying sum divided by count, you say sum divided by 5, and then n changes, that formula is not going to change, and you're going to be getting the wrong answer. Okay, so Alan, and you can read through the you can read through the rest of them. The last one is test your model thoroughly. I would hope that they wouldn't have to tell you that. Okay, that's like saying test the ice on the lake before you drive a snowmobile on it. You would hope that they wouldn't have to tell you that, but just in case, test it thoroughly, and so forth. So questions about the basic Excel stuff. Questions? Okay. Something that may be useful to some of you is, particularly those of you who can't bring a laptop to class, but you're working on something at home and you can't figure out why you're not getting the answer and you want to come ask me about it, and, it turns into a big thing. One of the things that you can do is to actually present the formulas in here, okay? And the way you do that under formulas, if you go to show formulas, then what that will do is instead of putting in the numbers, it'll show the formula. So if you're working on something at home, you just can't figure it out for the life of it. You want to come in and ask me or anyone else for that matter. Okay? This is one way you can get around bringing in a laptop. Do this and then just print it and bring it up. Okay. Sir. Yeah. Yes. Absolutely. Yeah, absolutely. No, it's 2010. It's Excel 2010. Yeah, there shouldn't be any differences. If you're working with 2013 and you do see a difference, let me know. I'm not aware of any, but like I say, there was one. I don't remember whether it was between 03 and 07 or 07 and 10. I think it was 07 and 10. There was one that pops up in the last third of the course, which we'll address in a second. Other questions? Yeah, the safest way to do that too would be dedicate some time to coming into the lab to do the homework and compare what you did at home on 2013 to the lab at 2010. And like I said, if there's a difference, let me know. We'll both know. Because we don't know about it. Okay. Other questions?
Do you remember where that show formula is on Mac?
No. I never use it. Where is it?
It's formulas and it says,
Show formulas?
yeah.
Yeah, well, it's the same thing as here. From the show.
Did you find it?
Other questions? Other
It
questions?
just says show, it doesn't say show on there. On mine it doesn't.
You got it?
Yeah.
Okay. All right, questions before we move into chapter 2. Going once, going twice, I'm being sincere. Okay, chapter 2. Let's get into some financial statement stuff. Like I told you yesterday, about the first week and a half or so of the course is more corporate oriented. One of our primary sources of information, even if we're investing, okay, one of our primary sources of information is financial statements. It really bothers me, not that I lay awake at night worrying about it, but it bothers me when I hear people say, yeah, the reason I majored in finance is because I can't stand accounting. Well, I understand that, okay, but you really can't divorce the two. I mean, I understand, if you don't want to be out there, doing debits and credits and that, actually gathering and presenting the information. I mean, I get that part of it, but you need to have an understanding of how that information is presented. I mean, and I think it's really as simple if you had a major repair to do at your home. Would you rather have someone repair it who doesn't know how to build the home or someone who does know how to build the home? Even though you're not requiring them to build the home. Which one's probably more competent or reliable to fix this major problem that you have, okay? So, on the one hand, I'm not going to turn this into an accounting course, but on another hand, as graduating finance majors, you should know basic financial statement presentation. We're not going to be doing debits and credits unless the question comes up and there's no other way to explain the answer. We're not going to be doing debits and credits, but you need to understand what accounts go where and what the accounts mean. Okay, in my opinion, you need to understand that. I've asked students before, accumulated amortization, and they tell me that it's an amortization schedule. Okay, that's not correct. Okay, and the problem with that is, and I'm not making fun of anybody, I'm just pointing out, the problem with that is, if you don't understand what accumulated amortization is, if you don't understand what treasury stock means, then you're not going to be able to effectively analyze financial statements. And therefore, you will probably not be able to effectively make a decision on the analysis of those financial statements, which is what ratio analysis is all about. Okay? I mean, if you're looking at, a ratio that involves current liabilities and you don't know what current liabilities are, then you're probably not going to really understand that ratio. Okay? So that's what we're doing here. So, like I said, on the one hand, I'm not going to turn this into an accounting course, but on the other hand, we are going to review, and believe it or not, they are just basic accounting issues. So we will start from the top. And that is, and I think this is really important for finance majors, especially. What's the purpose of the financial statements? What is the purpose of these financial statements?
Show the overall health of the company.
Okay. Yeah, how about to properly reflect the underlying economic reality of the firm. To properly reflect the underlying economic reality of the firm. That's the purpose of the financial statements, plain and simple. What is earnings management? And usually when I use that term, finance majors' ears perk up. What's earnings management? This is definitely something finance majors should be on top of. Yeah.
Just throwing something out there, to make sure that the company's doing the right thing with their earnings, like investing it or issuing dividends, investing it.
A good start, help them out.
Would that be where they manipulate what makes up the earnings to give the presentation they want?
And I think that's a good choice of words. Okay? Earnings management is also called income smoothing. I think this is absolutely critical for finance managers because you hear this earnings management stuff all the time. Earnings management is also called income smoothing. And we could almost do a whole course just on this, but income, time, we'll say earnings per share, let's say, and time. Okay? If your earnings, critical for finance majors, let's say that your earnings really are like that. Okay, so over the last 10 years, let's say, or projected over the next 10 years, that would probably be a better way to put it. Okay? So you have a very volatile company. Your earnings are jumping around a lot. Okay? Well, generally speaking, will investors like that or not? They will probably not like it because they don't like uncertainty. And that's what this is showing. One year, we have earnings per share of $5 a share. Next year, we have a loss of $2 a share. Next year we're up $7 a share. The next year we're down $4 a share. Investors are going to hate that, which means they're going to punish our stock. Okay? So through the process of earnings management, the goal would be to make our earnings more smooth. How would we probably accomplish that goal? Critical. How would we accomplish it? I mean, the details, there are a lot of ways, but big picture, how would we accomplish it? Exactly. By taking advantage of the gray areas in accounting, because recall from your accounting class, generally accepted accounting principles. Okay? Not accounting law, okay? Generally accepted accounting principles. And by taking advantage of some of the gray areas, we can potentially make our earnings appear smoother than they really are, which is to say make our earnings appear less volatile than they really are. Does that most properly reflect the underlying economic reality? No. That is, I'm not going to use the word fraud, but that is masking reality from the investing public. I'll say that to anybody. It really irritates me because we hear it so much that sometimes I think that we accept it as the way things should be. Okay? And that's not true because that is masking the underlying economic reality from the investing public. And that's not the purpose of the finance statement. Does it go on? Of course it does. In fact, my guest speaker, assuming he comes in, I emailed him today, see if he was going to come in. I haven't heard anything yet. But he comes in, he'll talk about earnings management a little bit. Does it go on? Of course it goes on. Should it go on? No. If you're an investor analyzing McDonald's, for example, would you want to know if they're managing earnings? Of course. Are they going to tell you they're managing earnings? Of course not. Which gets back to the more you know about how these numbers are presented and calculated in the first place, the better able you will be to uncover this kind of stuff. Okay? That's the point. That's the importance of this. Okay. Questions so far? Earnings management's a big issue, in my opinion. I think I recall a survey or something I read a while ago And I want to say that estimates are, or let me put that another way, of those who would admit to it, I want to say that more than half the companies out there were engaged in earnings management. Don't quote me on that, but that's stuck in my head. But that's just of those who would admit it. Yeah.
Is your earnings management mainly in deferrals and taxes, or?
Well, and that's part of what we're going to talk about here for the next, half hour going into tomorrow. That's part of what we're going to talk about. But, and the thing is, if they manage earnings by just hitting one account, like accounts receivable, are we probably going to be able to see through that? Yeah. They're changing their, receivable estimates every single year, and they're making drastic changes to it every single year. Yeah, I mean, we're all going to see that. But assuming they're smart, which they are they going to do it that way? No. What they're probably going to do is make subtle adjustments all the way up and down the financial statements. I mean, that's probably what they're going to do. I had a friend of mine one time who wanted to buy a bar. Okay, even if we want to get that business, good luck. You won't have to worry about competition from me. I ain't getting that business. And he asked me to look at the financial statements. This was back when I was in public account. I said, yeah, sure. But the first question I said, but who prepared the financial statements? And well, he did. And don't bother. Because, that's where you got to go in and audit all that kind of stuff. Okay, so purpose is to most properly reflect underlying economic reality. What's the difference between cash and accrual accounting? Cash and accrual accounting. In fact, let me try this another way. And I need to, should have done this before class, but I had someone here. So let me put these probably 25 to do it. Are these financial statements prepared under cash or accrual basis accounting? Ignoring the fact that it's McDonald's and publicly traded, and therefore you know the answer to that one. Why? Exactly. Very good. Okay. We know they're prepared under the accrual, or maybe like a modified accrual or something like that, but under the accrual because they have receivables on there. If they didn't, they wouldn't have those on there. So what's the difference between cash versus accrual accounting?
Cash transactions are recorded when you actually receive the money, and accruals when the transaction occurs.
Okay, close enough. I think we found our accounting major in the class too. You can. There you go. You want to help them?
A cash only recorded the cash transaction, but for accrual you encoded both the cash and the
okay. Close enough. The difference lies in when we record revenues and when we record expenses. That's the difference. Okay. Under the cash basis of accounting, revenues are recorded when they are received. Revenues. Under the cash basis of accounting, revenues are recorded when they are received, regardless of when they are earned. And expenses are recorded when they are paid, regardless of when they are incurred. In the cash basis of accounting. Okay. Publicly traded companies are required to report under the accrual basis, but to the extent you're dealing with non-publicly traded companies, okay, smaller businesses, they can be either cash or accrual basis. Okay. So again, the difference is when we record revenues and expenses. Revenues are recorded when they're received, regardless when they're earned. Expenses when they're paid, regardless when they're incurred. The accrual basis is the opposite. So revenues are going to be received when they are earned, regardless of when they're received. Expenses recorded when they are incurred, regardless of when they're earned. Okay. So far, so good? Okay. One of the things that they tend to do in finance, I'm going to say they because I don't do this, right? But one of the things that many tend to do in finance is to really bash accrual accounting. I mean, I'm sure at somewhere along the line in your finance training, you've heard someone badmouth, accounting income. That's a hot topic. Accounting income. Okay, and we go standing on our head, making all these adjustments to accounting income because cash is king, right? Cash is king. So yeah, so accounting income, right? Well, I don't buy that for 1 second. The easy argument would be, if that was true, then why would publicly traded companies be required to report under the accrual basis? And it's certainly not because everybody at the SEC is an idiot. That's not the answer, because they're not idiots. There might be a couple running around somewhere here and there, but overall they're not idiots up there. Okay? The reason, what I'm going to try and do is convince you very quickly that accrual accounting most accurately most accurately reflects the underlying economic reality. Okay? December versus January. All right, so we're at the year end. Let's say that in December we sell $100 million worth of whatever. And just to keep it simple, let's say that this is the only thing that happens in December. Okay, so ignoring everything else, this is the only thing that happens in December. All right, so we sell $100 million worth of whatever it is that we sell. We collect that $100 million in January. Okay, everybody with me?
Mm-hmm.
All right, under the cash basis of accounting, cash, how much revenue would we have in December? 0. And of course, we would have 100 in January. Under accrual, of course, it would be the opposite. Which one more accurately, they won't leave me alone for 10 minutes. And I got to leave it on because I'm waiting on this call, sorry about that. Which one more accurately reflects the economics of what really happened during those 2 months? Okay, would it be fair? But cash is king. And we're not receiving cash until January. Therefore, our company, all other things taking out of the picture, therefore our company is worthless in December, right? Because we haven't received cash, right? No. Of course not. Not in the real world. Of course not. Because even though we haven't received this, is there still value there? Yeah. Because if they don't pay us, assuming we have a contract, assuming we're not idiots, we have recourse against them if they don't pay us. Okay? So there is certainly value there. Right? If you don't like that, let's say you're a salesman who's paid on commission. Salesperson, paid on commission. Okay? Well, you sell in December, don't collect in January. Would it be fair to say that you didn't do SWAT in December? Of course not. Of course not. Okay? So my point is, this is why accrual accounting is required. And this is also why you took your accounting classes and why we're reviewing it here, because accrual accounting is complicated. Okay? Cash basis accounting is pretty darn simple. You get money in, money goes out. Okay? That's pretty darn simple. But all the rules of accrual basis accounting is what makes things complicated. But it's not that way just for the purpose of giving you a headache. It's that way because that's what most properly reflects the underlying economic reality of the firm. And as either investors or CFOs who are searching for value in order to maximize shareholder wealth, this is one of our primary measures of value. Is it a perfect measure? Of course not. Best we got right now. We're talking about this IFRS stuff, get to that in just a second, but it's the best that we have right now. Okay? But, and somebody brought this up a minute ago. Let's say that this $100 million, and this is where the devil's in the details, and this is where it is right here. Let's assume that this $100 million is a whole bunch of customers, not just one big sale we made, but a whole bunch of customers. Okay, we sold this in December. We haven't collected anything. okay, we're expecting to collect it in January. We've all agreed that saying 100 million in December is closer to reality than 0, right? Yes. Are we okay on that point?
Yes.
Okay. But in the real world, are we going to collect all this 100 million? Probably not. You know, it kind of depends. Probably not. I mean, you know, joining everybody else here on planet Earth, probably not. Therefore, what would most properly reflect underlying economic reality is to adjust that $100 million down in December to reflect the fact or 99.9% probability that we're not going to collect everything. Problem is we don't know what that is. And that's where one of our oh so many estimates comes into play, and that's how you achieve this. Okay? So when we start getting into these estimates, okay, well, if we had a really good year, and here's a good exam question for you. If we had a really good year this year, and we were interested in managing earnings, then what would our incentive be? I didn't say you would do it. I said, what would the incentive be with respect to these estimates?
Lower. Make that you only, you know, the receivables, you know, you're not going to collect as much as, you know.
Exactly. Because what that will do is that will increase our bad debt expense. Because if we're having a really good year, then we want to kind of sock something away for a rainy day. So we can kind of absorb a little more expenses this year. So our incentive would be to overestimate our uncollectibles. Because that would overestimate our bad debt expense, which would lower our earnings a little. And then next year, when next year rolls around, if we're having kind of a tough year, then we have something saved away, and we might do the opposite. Okay? Because when we make this estimate, just for sake of conversation, we might estimate that between 2 and 4% of our receivables are uncollectible. So this year, what we might try and do is write off 4%. Next year, we might try and write off 2%. Where you guys know enough about statistics at this point to know that really what you probably should have been doing is writing off 3% both years. Yeah.
Is that like a main reason why companies sometimes like miss or beat on earnings?
Well, that's part of that process. Is they have tremendous incentive to meet their earnings expectations, because you guys know from market efficiency that those expectations are probably what's built into stock prices. So if they miss them, okay, if they miss them on the downside, obviously that's going to be bad for their stock. Okay? But if they miss them too far up on the good side, although the stock will pop now, that might set them up to miss on the bad side next year. And you'll hear my guest speaker talk about that, because he was actually in a moral dilemma over that.
So do analysts like try to predict what they're gonna do, like what the company's gonna do?
I hope so.
I mean, like, so like sometimes they're wrong, sometimes they're right. Is that why like companies beat or miss sometimes?
Yeah.
Most of the time? Or?
Yeah, and I mean, that's a difficult question to answer, because you're asking me to speak for every analyst out there, and I can't do that. But I'm being sincere when I say I would hope that analysts do that. But see, this is part of you guys outthinking them. You know, anybody who has had one finance class can pull up an income statement and look at earnings per share and see whether it went up from last year. Everybody can do that. Okay. What I want for you guys is to help you go deeper into the details. Question. Continue. Other question.
Kind of a comment about revenue and do analysts project. Yeah, I work as an intern right now, and my job is to predict revenue for the next 6 months, year to year, years. So yeah, we absolutely predict, and it changes every time you update your prediction. It changes. So hopefully, 2 months out, you're way more accurate than a year out, because that kind of gives you can tell there's, okay, 2% growth, 3% growth, and it's usually pretty consistent, so absolutely predict revenue.
Yeah, and I'll be interested in your comments next week. One of the things I don't think we talked about enough in finance is forecasting. And we're going to be talking about that in chapter 5 next week. By the way, side note on this before I forget, you'll see this on the syllabus. I have some supplemental information posted for chapter 5. Make sure you download that. That's on Canvas. I think it's under course resources, I think. But there's not that many links on there. It's on there. Make sure you download those for chapter 5. We probably won't need it till Monday at the earliest, but make sure that's on it. Yeah, we're going to do some forecasting stuff. One of my former students actually works overseas for one of the Fortune 500, sparing you all the details. She was telling me about sales forecasts they do, and what she does, which I presume is kind of what you're doing, is she would forecast really just for her little area, okay? And then that gets rolled up into everybody else forecasting in their little areas, and then the CFO on top is the one that rolls all that together, and that's presumably what is given to the market. Okay. All right, other questions? Other questions? And other questions? Okay, let's see, where are we at? All right, so cash and accruals. So again, the point of that was to hopefully convince you that accrual accounting was more accurate, which is why we're using it in the first place. Okay. What's the difference between the income statement and the balance sheet? What about time?
The balance sheet is a snapshot of what
Okay. Balance sheet is prepared as of a point in time, whereas the statement of income is prepared over a period of time. Okay. Usually, they're usually the quarterly or annual. We will always assume annual, unless I tell you different before I forget, so we'll just assume annual, which is also, we're assuming calendar year end, but not necessarily. Okay. This is calendar year end. Some of them are what's called fiscal year end, of course. What is the statement of cash flow? This is another one. This is another kind of hot button of mine. Statement of cash flow. What is the big picture? What does the statement of cash flow tell us? Okay. This is McDonald's balance sheet, which it looks like we're not going to get too much into today. Okay, this is McDonald's balance sheet. December 2012, they had cash of $2.3 billion, into 2.336. Into 2011, cash 2.335. Okay. What the statement of cash flow tells us is how we got from 2.335 to 2.336. And the reason this is one of my hot buttons is for the same reason we were just talking about over here, is that I've seen, particularly when I was teaching business analysis, I ran across several of these templates that some in finance use to convert or try to convert accrual basis accounting statements into basically cash basis accounting statements. We've got the statement of cash flow right there. That's telling us where our cash came from and where it went. The problem is that statement of cash flow, it's certainly complex to prepare, but it's also pretty complex to analyze. Not many people really understand it. Well, if you guys understand it, then that gives you a potential edge over everyone else who doesn't understand it and is too lazy to try and understand it. But we've got that information right there. And in fact, that's one of the things I like research to do, which I haven't gotten around to it yet. But it's on there. Okay? So we'll look at the statement of cash flow as well. I talked about that. I definitely talked about earnings management. Oh, how are financial statements prepared? For example, on McDonald's, they're saying that property, plant, and equipment, and if you can read this, it's actually cheating, so I'm going to try and stay in the way, is $38.4 billion. Okay. What does that probably represent? Let me put that another way. What does that represent in the beginning? At the basic level, what does that 38.4 represent? And this is all in the context of how financial statements are prepared, yeah.
Leases and stuff on property?
Well, that's a tricky statement, depending on the type of lease. Tricky statement. I'm getting something more basic than that.
Acquisition price?
Okay. Financial statements are prepared at historical cost. At historical cost. So this 338.4 generally represents the price that they paid for this property, plant, and equipment, not what the property, plant, and equipment is worth
today.
now. That's a huge difference. Because if you think, oh, well, they own this property and equipment, and it's worth almost $38.5 billion. That's not correct. Okay? That is historical cost. That's actually one of the things in this IFRS stuff, the International Financial Rules. I'm not exactly sure where we stand on that at the moment, but as of about 6 months ago, we were looking at incorporating that. That's going to change all of your analysis. And good luck. I mean, I'm happy to be here talking about the theory of it instead of having to deal with the reality of that. Because the hot topic there is that they're, from what I understand, they're going to go back from historical cost accounting to fair market value accounting. Which, in my opinion, and they don't care what my opinion is because they haven't asked me, but in my opinion, that's stupid for two reasons. Number one, the reason they're talking about all this stuff is because of all the accounting scandals that have gone on, right? Well, fair market value accounting is clearly more subjective than historical cost accounting. So if we're trying to prevent future scandals, how are we doing that by making our financial statements more subjective? If you can explain that one to me and convince me of it, I'll give you extra credit. I mean, that makes zero sense to me. None. Actually, a couple months ago, I heard from one of the guys from the Financial Accounting Standards Board who's deep in all this stuff. I mean, he's on the front lines doing this stuff, talking about it, and when that subject came up, he kind of skirted around that issue. And I didn't press the issue, but I noticed that we skirted around that issue. I mean, that's going to be a huge mistake. The second reason is because that's why we're in historical cost accounting in the first place, because part of the blame for the market crash in 1929 was that before that, we were reporting fair market value. But you guys know as well as I do that if you get 10 appraisers to go out and appraise this property, you're going to get 10 different values. Which one is management probably going to pick? The one that makes them look the best. Huge. I mean, that just makes no sense. They didn't ask my opinion, so I have no influence over that. All I can do is run with it. I'll go on record right now. If they actually do that, I'm going to be trading that. I was asleep during the dot-com bubble in the 90s. I was asleep during the real estate bubble in 2000. I'll be fully awake for that one because, in my opinion, what's going to happen is what we just said. If they actually go to that, you're going to see a bubble in stock prices. Because all the companies out there, you know, it might take a couple of years to kind of work its way into the system, all right? But you're going to see companies making themselves look better than they really are. But then when you guys, who by that time are fully entrenched in your careers, and you paid attention in this course, you went through all this stuff and you sifted that out, and you said, no, it doesn't make sense that their property's worth $58 billion. That doesn't make sense. And when you guys start selling, that's going to burst the bubble. Hopefully, I'll be on the long side of the bubble all the way up, short side of the bubble all the way down. Starting tomorrow, we'll pick up with these, and we'll also do the